This week I'm joined by Jon Pemberton from Blevins Franks. How are you doing, John?
Yeah, very well, thanks, Howard. How are you doing?
I'm doing very
Keeping
well.
well?
Yeah, nice to catch up, but we have something very important to discuss over the next couple of weeks.
Indeed, we do. Yes, a subject which is very dear to many people's hearts. That's for sure. Certainly of our generation.
I think we can call it a hot potato.
Indeed.
Okay.
Indeed.
Well, this subject is causing concern among many British families this year. The mounting impact of UK inheritance tax. Over this week and next, John would explain why inheritance tax receipts are rising so fast, the impact on pensions falling into the I.H.T net, and how to protect your wealth and legacy for your family. So, John, how much does HM Revenue and Customs earn from an inheritance tax these days? And how does this compare to, say, 10 years ago?
Yeah, thanks, Howard. Many of us, our sort of era will remember that Roy Jenkins famously stated inheritance tax is, broadly speaking, a voluntary levy paid by those who distrust their heirs more than they dislike the inland revenue. And I think at the time the reason that statement was made was that with careful planning, inheritance tax could potentially be avoided. But the circumstances, and that was in 1986, so circumstances have certainly moved on. And the HM Revenue and Customs inheritance tax receipts have been rising steadily for more than 2 decades, but the pace of growth is accelerating sharply. The amount collected in 2005-06 tax year was around 3.3 billion, which grew slowly to 4.65 billion by 2015-16, so that's just 10 years. And 10 years later, the official figures reveal that the HMRC collected 8.5 billion over the 2025-26 financial year, which is pretty much double. And looking ahead, sadly, the figures become starker still. The OBR's March 2026 Economic and Fiscal Outlook estimates inheritance tax receipts will climb to almost 15 billion a year by 2030-2031. So again, nearly double the level seen just a decade earlier. It estimates that around 1 in 10 estates will be paying inheritance tax by the end of this decade, compared with roughly 1 in 20 today.
So why are the I.H.T receipts rising just so much?
Well, the nil rate band has been frozen at £325,000 since 2009, so 17 years. And the main residence nil rate band at 175,000 since 2020. Both will remain unchanged until at least April 2031. Now, had the standard nil rate band risen with inflation since 2009, it would now stand at £525,000. And so for a married couple, that represents an additional £400,000 that could have been passed on tax-free. Instead, fiscal drag has steadily pulled more estates into the I.H.T net, and with another 5 years of freeze to go, sadly. While the residence nil rate band can give a couple a total inheritance tax allowance of 1 million, it tapers away once an estate, the whole estate, not just the property, exceeds £2 million, reducing by £1 for every £2 over the threshold. For estates above 2.35 million and potentially 2.7 million for a couple, it disappears completely, making relatively small increases in estate value disproportionately expensive from a tax perspective.
Are there any new changes to inheritance tax on the horizon?
Yes, significant changes are on the horizon for UK pensions and estate planning. Pension funds will soon be included in your estate for UK inheritance tax purposes, a reform that could dramatically increase the tax burden on your heirs. So are you prepared? Historically, UK pension funds have generally been exempted from UK inheritance tax when passed on to beneficiaries, but this is changing. From the 6th of April 2027, so not very far away, any unused funds and death benefits will form part of your estate for I.H.T purposes. Pension pots after properties are often the largest or second largest asset people will own. And the OBR estimates that this change alone will bring around 10,500 additional estates into the inheritance tax system in 2027-2028, with many tens of thousands facing significantly higher tax bills going forward. For estates already near the 2 million taper threshold, which we mentioned earlier, adding pensions back into your estate can trigger an effective 60% tax charge once the loss of the residence nil rate band is factored in. This reform is expected to impact hundreds of thousands of British families, and expatriates are also affected regardless of how long they've lived abroad.
How much impact will pensions falling into the I.H.T net have on British families?
Well, how much more tax will your children pay? We look at a typical British expatriate couple living in Spain, though it also does apply to other countries as well as UK residents. I'm actually going to talk about an existing case that I had not so long ago. I'll change the names. So John and Jenny moved from the UK to Spain in 2023 when John retired. They opted to keep their UK property worth £500,000, which had been their family home since the children were young, as they visit a few times a year to spend time with family and friends. They would also like to leave it to their daughter eventually. They used some of their savings to buy their new Spanish home worth £350,000 and left the £260,000 balance invested in the UK. John also had a self-invested personal pension worth £720,000. At present, their total estate liable to inheritance tax is just over £1,110,000 since John's SIP is excluded from inheritance tax. Their combined nil rate bands, so that's personal and residential, amount to £1 million, so the taxable estate is £110,000. So without their pensions being included within their estate, their tax liability is £44,000. So manageable, I suppose, for their heirs, not too bad. However, from April 2027, their financial situation will change significantly. And John's pension, which is £720,000, will be added to their estate, bringing the total value for inheritance tax to £1.83 million. Their I.H.T allowances, however, remain at £1 million. So in 2027, with their pensions included, the resulting inheritance tax liability is £332,000. Now, if you remember, the previous tax bill was £44,000, so that's a 655% increase.
Thank you, John. You've given our British listeners a lot of food for thought. Let's be more positive next week and look at how people can reduce inheritance tax liability for their family. In the meantime, how can listeners get in touch with Blevins Franks if they want personalised advice?
Yeah, thanks, Howard. If people go onto our website, which is www.blevinsfranks.com, and you can locate your local office, your local partner and team within that office, and please do get in touch, and I'm sure we'll be able to help.
Many thanks. We'll catch up again next week.
Lovely. Thanks, Howard. Take care.